Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Weinstein of Morgan Stanley writing the Fed is now seen as ahead of the curve. The door is totally open for another 50, but the bar is high. The Fed is better off dragging this one out. From here, having gotten off to a good start. Brian joins us now for more. So Brian, easing in China, rate cuts to the United States, the prospect of some inflationary policies in D.C., dependent on the outcome of the U.S. election. A lot of people asking the same question. Why aren't bond yields higher, not lower?
I think we'll get there. It's going to take a little while. Listen, I think the playbook says when the Fed is easing, you buy bonds, right? People want to lock in rates. It's very rare. In fact, it's never happened before that we've come from such an inverted yield curve right into an easing cycle. And so I think people are missing that the trades more or less already happened. But in the meantime, any weaker data, any Fed easing, people will buy bonds. So I believe bond yields will be meaningfully higher than here. I think it's going to take a little while to get there.
Let's just dig into that word, meaningful. Can we talk about that? You think we're at the bottom of a much bigger range. How big is that range? What is meaningfully higher?
Listen, I came into this year saying 390 to 5, and obviously I'm a little bit off on the low side. So let's say it could be even a little lower, 325, 350. I think when you look at a Fed with a terminal funds rate near 3, the yield curve should be at least 150 basis points steep. So that puts us at 450. If the terminal rate's 3.5 or 4, well, then you go a lot higher. So listen, I don't think we've seen the highs in yields for this longer cycle yet. So if we touch just short of 5%, I think you could see a 5.5% 10-year note. If the Fed does everything right, if the data gets better, and China easing is a big part of that story. So you need more stimulus, more spending, all the things we're going to get. I think you can get 10-year notes outside the range of which we've seen to the high side much later next year.
This is counter consensus in terms of how high the yield could potentially be in this cycle. It is not counter consensus when it comes to just volatility expected, especially heading into the election. How do you trade around this? How do you position for that type of whipsaw?
Yeah, well, what's amazing is nothing's happening, right? We're kind of stuck in this 370 to 390 range. I mean, this is the tightest range. The rally happened over 5 months, and now we're stuck. So I think the answer may be don't expect what I just said to happen anytime soon. Again, people like fixed income. They want to buy bonds as the Fed eases. And listen, the election, I don't know that unless there's a red sweep or a blue sweep and there's a big outcome that's unexpected, I'm not sure the market isn't ready for it, right? We know we're going to get some more stimulus after. We know we're going to help out the hurricane victims. It's a little slower than we'd like. And so there'll be more spending. But there's also going to be an economic slowdown, right? I mean, I don't think it's going to be huge from here, but inflation is still falling. So I think we're stuck in a bit of a range, maybe for stocks too. And then when we get through this, when we get into January, February of next year, and you see the effects of the Fed easing, I think you start to see higher rates, but it seems a little bit boring for right now.
Well, see, this is what I was really struck with. And over the weekend, I spent a lot of time thinking about the idea of how you navigate bifurcated tails. This idea that you have a potential hotter than expected economy or you have a potential weaker than expected economy. And right now, people aren't willing to make any kind of bets. They're just betting on perfection in the middle for the foreseeable future. You're saying that we're not going to get a catalyst to change that until next year, that even though we're saying that Friday is the most important payrolls ever, that's not necessarily going to tip the tide one way or another.
I think it's, by the way, I think you're right. I think we're priced for perfection, and I think the tails are in play. The problem with, say, Friday's payroll is if the Fed hadn't gone 50, right, if the Fed had been stubborn, the payroll would matter a lot. The fact that they're ahead of the curve, now we know if it's weaker, they can go 50 again, so you can get a response. If it's not weak and they did a little too much, the curve might bear steepen a little bit, or maybe even bear flatten, right? Maybe we take out an extra ease. But at the end of the day, is it going to change the course of what they're doing? I don't think so, right? We know inflation went from 8 to close to 2. We know that employment is weaker than it has been, maybe not super weak. So it leaves me thinking, as much as I don't like it as someone who wants to help their clients make money, you're stuck in a range for a little bit longer, despite the fact that you do have these tail risks. And if we overreact to one, you probably want to fade it, right? Which puts you right back into that range concept.
Brian, does this remind you of the inverse of pre-2020? The line that really got that going in my mind was we're a long way from neutral. I remember that line, and they ended up being a lot closer to it than they realized. Are we going to see a repeat of that from the other side?
I think it's possible, right? I mean, it feels like we're a long way from neutral, but we don't know where neutral is. And we didn't expect 5.5 to be necessary. And it was, which suggests that neutral is higher, right? The economy did not fall off a cliff when we got to 5.5. And we're easing not because we are in danger, but because we don't want to be. And that's why I'm so emboldened with a higher rate call for later. I don't think neutral is going to be 2.8 or 3. I think it could be 3.5 or 4. And so, yes, John, that's where we are, right? I think it looks like we're far from neutral, and we won't know until it's a little bit too late. And the impact of the eases won't be known until the middle of next year. So a lot to learn, a lot to get through. And I would be thinking not about what this easing cycle looks like in the next couple of months. I think it might be boring. It's what's on the other side of that.
Agreed. Brian, it's good to catch up. Thanks for catching up with us. Brian Weinstein there of Morgan Stanley. Venu Krishna of Barclays is staying cautious, saying we would note that despite upbeat sentiment in financial markets, our macro research colleagues believe that impacts to China's real economy are likely to be limited. Venu joins us now for more. Venu, it's good to see you.
Good to see you.
Are you not buying the happy talk out of China in the last week?
I think in the short term, all these measures could work, given how negative the positioning has been in the sentiment. But I think the issue with China is much bigger. It's structural, demographics, the property market, consumer sentiment, a host of things, domestic consumption, right? Which is you can't export your way out forever, which is what they're trying even now. So I think that is the question. So I think in the short term, it's tough because the questions of what, is it a gun or is it a bazooka or whatever, right? So you fine, you bring your bazooka and does it. But structurally, over the longer term, what changes?
How would you describe the move over the last week? Is that just shorts coming off, new longs going on, a positioning squeeze that turns into a bit of a mount up in the short term? What would you call this?
I would say it's a combination. It's a big relief as well, because so far the concern has been that in the past, they've thrown in a huge amount of stimulus. They weren't doing it this time. And so the concern was that they don't care as much. But now the opinion is that they do care. And now they're saying that this is very important and they're going to do something about it, right? So I think it's a combination of all those. And perhaps it has some staying power. But I take a step back and say, just like the U.S. economy, the reason you're optimistic is structurally there are a lot of things different in the U.S. It's not the same in China. So when you put all those facts together, I think it's a wait and see.
So you said that there are some structural things in the U.S. that are good. So you're bullish on the U.S.
Yes, I'm still bullish on the U.S., though I'm a little concerned at the pace at which we are going ahead. I think it looks too fast, too soon. But structurally, for example, the U.S. remains at the forefront of the technology front, unparalleled. We are still one of the world's biggest economy, right? We are the world's biggest oil producer now. And we still are at the center of probably the leader of the global financial architecture. And the dollar still remains a reserve currency, unlikely to change. So I think when you start putting all that together, mainly I would say even tech, because the secular shift in the markets right now is around technology. And the shift in technology, if you take a step back, is not something which is new. It's been going on for about 3 to 4 decades now, from the PC cycle to the internet to mobile devices. We were in the middle of a cloud transition, and then you got AI on top of that. And at the center of it is the action is coming from the US. And the ecosystem we have in the US, mainly around the Valley, is unparalleled and cannot be replicated just by infusing capital.
That's a great story.
Yeah.
You expect losses by the year end. How much short term do you expect this story to have been overplayed and basically everything to really face a whole lot of volatility based on potential growth headwinds, potential regulation, potential geopolitics, the election?
Absolutely, you raise a lot of right points, and that's why, if you see, my base case price target is 5,600. We're already above that, but we do have an upside case of 6,100, and in all fairness, a downside case of close to 5,000. So I think the way to think about it is big tech has corrected reasonably healthily. Multiples which had gone to about 34 times are now back to about 29 times. So just about the threshold where we feel comfortable. I think anything in the mid-20s to 29 in the range is reasonable because their growth is decelerating. So they are comping the comp. In other words, now they are looking at 60% plus growth rate to sort of match against in the coming quarters. And the expectation is that their growth will decelerate to around the 20% range. So pretty healthy. You're paying a PEG ratio of 1.3, 1.4, which is quite full, but it's not broken. But for the rest of S&P, the comps get easier. So you had bad numbers. Now the street's expectation is it goes up 15, 16%. I'm skeptical. I think it's going to be less than that. But still, directionally what's happened is the composition of growth has changed. So big tech still leading, but moderating, reasonably priced. And the rest of the S&P quite fully valued, I would argue, but growing at, expected to grow, in my view, maybe around 10-ish%, which is not a bad combination. It leaves me to your question that what about the levels right now? I think we probably need to take a little bit of a breather. And I don't know what the catalyst is going to be. Maybe it's elections, maybe it's some geopolitical event, but we haven't cared about geopolitics forever. So I'm not too sure why we'll start caring now.
You have such a big gap when it comes to the upside and the downside.
Yeah.
And you say, you don't know the catalyst for what could be. Is
Sure.
there a potential of what the catalyst, though, would be to the upside if you're unclear about what it would be in terms of taking a breather?
Sure. I think the catalysts are very clear. You talked about the jobs numbers just now. So the big shift in sentiment over the last, call it, month or 2 months has been this growth scare, right? And so based on historical experiences, the market is very concerned, and we are, that is the labor market as robust as it seems? Is it a fact that labor market can decelerate very quickly? We don't know. We don't think so. But the point is, it is very clear that the odds of even a shallow recession have increased over the last 2 months. They haven't decreased, right? So that is your case, downside case. If you start suddenly seeing a deterioration in the labor market, which nobody is expecting, including us, but it is a real possibility because the odds have increased, you could start testing the downside. On the other hand, we are still printing very robust numbers. You saw the Atlanta GDP number. It came even stronger. Consumer sentiment marginally increasing. So I think if growth does accelerate, and there's a reasonable likelihood, even though that's come down a little bit, there you have my upside case of 6,100. So I think, it all depends. And the derivatives market is telling you that the one thing they care about is the NFPs, right? So, that's where the action is.
So good news is good news still. That doesn't change.
Yes. Right now, the good news is good news. We've shifted from that paradox of flipping it back. But I think the question is good news till something breaks, right? And so the disconnect right now is between the rates market and the equity market, right? And what I would suggest is that the rates market has been all over the map for the last 2 years. We're expecting 7 cuts, then 0, now 9 cuts for the end of middle of next year. So the equity market has been more right than wrong, right? And so that's an interesting situation we are in, right?
You throwing some shade at your colleagues on the other side of the room, that the bond market's been all over the place. Did you hear that? I heard that.
I heard that. So, basically, is that your accusation?
Well, my point is that everybody looks at the rates market as a big barometer of what to expect.
Smart money in
right?
the room, yeah.
So which is true, but my point is if you tried to follow that, you'd have gone crazy because you wouldn't know what to do a week from week, right?
Okay.
It's flipping.
All right, hold on a second. In fairness, so not to defend the bond market, but to defend the bond market, equities have had, S&P 500 has had 5 straight months of gains if we close out the month of September with a gain. It has come in tandem with 2-year yields having 5 straight months of yields going down. You're saying that that isn't directly correlated?
Well, what you really care about for equities is the 10-year rates. Right? And if you look at 10-year rates, wherever they're moving around, well, that is a discount factor because we're a long duration asset, right? And we were hovering around 5% a few months ago, right? And then we went to 3.5%. Now you're again going back towards the 4% range. So I'm not trying to sort of reduce the importance of the rate market. It is very, very important because it is a discount rate just factors in.
He's trying to bring back his bond market colleagues. Carry on. Come on, keep going.
But at the end of the day, it's been all over the map. And let me tell you something. So everybody in the macro market is concerned about deficits, right? So you would expect that shows up in the term premium. Where is it?
Some big egos on that side of the room, as you know. Venu, thank you. Venu Krishna of Barclays. Markets looking ahead to the week's biggest catalysts, including today's remarks from Fed Chair Jay Powell ahead of September payrolls on Friday. Aditya Bhave of Bank of America Securities expecting a print of 150,000 with unemployment holding steady at 4.2%. Aditya's with us in the studio here in New York. Aditya, good morning to you, sir.
Good morning. Thanks for having me.
Thank you for being here. We've heard from consumers. They say jobs aren't as plentiful. They're getting harder to get. Are we going to see that in job openings this week?
It's certainly a possibility. So if you look at the JOLTS report, this will of course be for August rather than September. But if you look at the recent JOLTS data, that job openings number has been dropping like a stone. And that's not sustainable. At some point, that's not going to be benign, right? It's going to start affecting the labor market. So that's something we're watching quite carefully. The openings rate now looks quite consistent with where it was before the pandemic. So further sharp decreases in openings will be a point of concern.
There's a missing feature in the bearish narrative. It's layoffs. What's happening with layoffs? Where are we?
Layoffs are still very low. And that's the reason that we're holding on to our soft landing outlook. If you look at the layoff rate, that's been low. If you look at jobless claims, that's been low as well. And even within the unemployment data, you can look at kind of voluntary versus involuntary unemployment, where involuntary would be layoffs, right? So that only accounts for a little more than half of the increase in the unemployment rate. So no matter how you slice it, layoffs have been low, and that gives us more confidence about a soft landing.
Also revisions. And this is sort of counterintuitive because some people are saying the revisions to jobless claims and to the jobs figures have been downward, and significantly so. But the revisions to GDP and GDI were the opposite direction and suggested quite a bit more growth in the couple of years in the direct aftermath of the pandemic. How much are you looking at that and saying we need to rethink the strength in the economy?
Oh, absolutely. Those revisions were remarkable. So there was a big gap between GDP and GDI going into the revisions, with GDI being significantly softer. So the bearish view on that was that eventually GDP would get revised to GDI because income is more easily measured or something like that. But actually what happened was that GDP got revised up, GDI got revised up even more, and it's now basically caught up to GDP. So across the board, you look at the components of income and compensation, for example, got revised up a lot. You look at the components of GDP, consumer spending, CapEx got revised up. So these were very positive revisions, and I think there's two potential implications, right? The first one is that productivity growth has really picked up more than we expected. The other is, look, eventually there's going to be a relationship between activity and the labor market. And which way will it go? Will activity backstop the labor market, which is now looking like a bigger risk given the revisions? Or will activity collapse under the weight of a softening labor market, and now that's looking less likely?
Okay, so this to me brings me to sort of the paradox that we're dealing with right now in markets, which is you've got two tail risks that are diametrically opposed. Brian Weinstein earlier this morning really highlighted that, and he said people are underestimating the growth in this economy and overestimating how low the neutral rate is. It actually is going to be much higher than the Fed says, and that really they don't have as long of a way to get to neutral. Yeah. Do you agree, based on some of these revisions and the amount of momentum that there seem to be in the economy heading out of the pandemic?
Sure. So to the extent that productivity growth has really picked up, very mechanically, that does mean a higher neutral rate. I think eventually We'll know the neutral rate when we get there, so
that's
we're
not
probably
good enough. Come on, give us advance notice.
It's probably higher than it was before the pandemic. Chair Powell said that as well. The question is it high twos? Before the pandemic, it was low twos, right? So is it high twos? Is it mid threes? Or is it even closer to 4%? And I think all we can honestly say about the neutral rate is that it's somewhere between 2.5 and 4, and we'll know when we get there.
Aditya, can we ask about what's potentially going to happen in the next few hours? We know what's going to happen. There's going to be strikes at ports. What could be the impact on the economy?
So there's two things that we focus on when we think about the impact of strikes on economic activity. The first one is that the longer they last, the more of a drag they are, but not in a linear sense, but rather in a non-linear sense at some point, because then they start to affect supply chains, right? So a 1 or 2 week strike is pretty painless, right? The other thing is that because GDP is a flow variable, whatever impact they have usually gets paid back the following quarter when the strikes end. So it'll be a temporary impact. It'll show up. It won't show up in claims because when you're striking, you can't apply for jobless claims, but it will show up in employment.
So what's the cutoff when it actually can become more damaging down the line?
It really depends on how many people are striking, how broad the strikes are. So there's no fixed sort of cutoff, right? But when we were thinking about the auto strikes last year, for example, we were thinking, once you go beyond 4 to 6 weeks, it gets a lot more painful.
So how much do I need to strip out from Friday's number? Do I need to strike adjust this number?
Not really, no, because the survey period was the week of September 12th.
Do I need to cut off 60 because of revisions?
You need to account for the fact that Chair Powell is cutting off something, right? He didn't say what, maybe it's 40 to 60, but this I thought was really interesting in his press conference. What he said was, we are mentally adjusting down the jobs data that we get, right? So there was a question about whether the downward revisions from the QCW, which ended as of this March, would extend to April and beyond. And he's saying that the Fed is working on the assumptions that they will, which is quite dovish, right? Because if you're trending around 120, 130, you could easily just idiosyncratically get a soft number around 60, 70, 80, and then Powell's thinking of that as being very close to zero. So that actually makes a pretty strong case for another 50 from our perspective. So
I'm going to take a line from markets philosopher Jonathan Ferro, who is talking about the whiff of Goolsby. If we hear the whiff of Goolsby at 1:55 p.m. today from Jerome Powell, how much does that risk a reacceleration in the market with a series of 50 basis point rate cuts that reignite the growth side of the equation?
It's a risk. The question is how many 50s can Powell pull off, right? So if you look at the dot plot and you take it at face value, which I would recommend you don't do, but if you did, then it would say that they're not going to do any more 50s. Right, we think they'll do one more, but each one that Powell pushes through, we now have a strong sense that he's more dovish than the rest of the committee. It's going to be harder. They're going to face more resistance because each one you do, you're telling the markets that we're not going to stop, and you're getting closer to neutral, so maybe you don't want to do too many. So our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed. You could get to 25s if the jobs data are good. You could get very, very fast cuts if the jobs data deteriorate further.
What are you focused on this afternoon? Just a final question. What are you looking for from the Federal Reserve Chair?
I think he's going to be pretty non-committal. There's 2 more jobs reports before the next meeting. He really, really wants to keep his options open, so it's going to be data dependence. He probably used the word recalibration again, which again for us, if you're recalibrating, why only do that one extra 25 basis point increment, right? You want to do at least one more. But he's probably going to talk about recalibration, and he's going to mix this very optimistic message about the economy with a more dovish message around, we'll do what it takes to accommodate the labor market.
2 payrolls report, I think 1 CPI report, and a presidential election in between the next decision.
Yeah, it's going to be really tricky. You got to imagine that if he lays the groundwork now for, we're going to dove, that will just, take away a lot of the uncertainty and the potential
accusations. Imagine if he actually spoke like that. We're going to dove. Aditya, it's good to see you. Aditya Bhave of Bank of America.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.